Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand with the latest cues from the stock markets. And also as a special, we will be discussing the Q3 earnings review with a guest to understand, what do experts really make of the kind of earnings season that we've seen thus far, which is almost over, and also what opportunities really lie for investors after the Q3 earnings as well. First up, a quick check on how the markets are doing at this point in time. Slightly muted trade is what you can spot amidst the volatility that we've been seeing right from the word go today. 17,911 currently for the Nifty 50. It's down about 30 odd points. The Sensex hovering 68 points lower in trade at 60,934. Overall, if you see, we are seeing that this is the expiry week and therefore there's this volatility and the markets are trading flat with a negative bias. Banks, pharma, metals are the big drags today. While IT stocks still look better, Cipla, for example, those kind of stocks are actually pulling down the pharma index. It's plunged 6% after the US FDA issues 8 observations in the Indore unit, and therefore you're seeing the pharma sector also dragging in trade today. Apart from that, if you see, only two sectors, about auto and IT, they are still about half% up in trade, stemming the kind of losses that we are seeing. But overall, it's a larger market breadth which is skewed towards the declines today. 27 declines to 23 advances when you talk about the market breadth as well. In terms of the big drags on the Nifty index, Cipla, like I told you. Apart from that, Adani Enterprise is still down 5%. Nestle, BPCL, Tata Consumer Products is also down. What's holding up instead is Ultratech Cement, Tech Mahindra, Divis Laboratories, Bharti Airtel and Power Grid kind of stocks. But time now to welcome our guest for the day. We are joined by Hemang Jani, Equity Strategist and Senior Group VP, Motilal Oswal Financial Services today. Welcome, Mr. Jani, and thank you so much for taking the time out for this discussion. First up, a quick word on overall markets as well as to how do you really see the current setup. It has been a pretty volatile last week as well. And now as we begin this new week, what can we really expect?
Hi, Sakshi. I think we are going through a bit of a subdued moment, particularly, last 2, 3 months have been tough, and even this earnings season, there are not too many surprises. And globally, also, things are not looking that great, particularly post the inflation print that came out from US. It is going to be a little more subdued, from a global perspective. So we think that the market could get into some sort of a consolidation phase,
Yeah.
and you could see a maybe 5% plus or minus kind of a movement. No
Hmm.
major triggers as the earnings season is behind us. But yeah, in terms of the MSCI rebalancing, FTSE rebalancing, those kind of things will have some impact on the stock specific movement.
Okay, understood that. And since our special today is on the earnings, so let's get straight on to that. Overall speaking, Motilal Oswal has also released this report of earnings review as well. So key findings from that is what we will understand. First up, Q3 earnings as an overall. How did the Nifty companies perform, and how did the entire Q3 earnings really pan out for you?
So the Q3 was a bit subdued quarter, and there was some miss at the aggregate level. So talking about the Nifty earnings, they stood at about 11% versus expectations of 14%. Uh, Major drags were commodities and also metals, cement, healthcare, telecom. This is where we had seen some underperformance, and there were 3 to 4 sectors that did well. So
Okay.
financials did very well, auto did well, capex and IT. These were the 4 sectors that did relatively better.
So what was the earnings beat versus earnings miss kind of dynamics that you pointed out in this earnings report?
So see, basically, there were more misses than the hits. And when you look at the overall number,
Yeah.
37% of the companies under our coverage, they beat the estimates, and almost 43% missed the estimates.
Hmm.
But there is not much of a change at the aggregate level of the Nifty, EPS as such. There is hardly about 1% kind of a cut that we have seen.
Hmm.
Uh, Not too much of a disappointment at an aggregate level, but we are finding that more and more companies are underperforming, and there are downgrades versus upgrades.
Okay. So in terms of, since you just pointed about, the kind of sectoral moves that you actually saw, what were the key highlights when it comes to sectors like banks, autos, tech and consumer sectors per se?
So see, when it comes to banks, clearly they reported extremely good numbers, both private and public sector. With there's a healthy loan growth, margin expansion in most of the cases, asset quality, no major surprises. So
Yeah.
banking was something that one can say that it really was the at the forefront of the entire upswing that we are seeing. Apart from that, I think auto volumes have been growing YOY, except two wheelers. And there is a very decent amount of improvement in terms of the chip availability. So, auto as a sector is still holding out pretty well. And technology versus the expectations, where things are a little challenging globally. There is a recession fear. There's a layoff which is happening. So, versus
Yeah.
that backdrop, I think the companies delivered reasonably well, and this is definitely helping in terms of the sentiment.
So in terms, I think there are about 2021 sectors under your coverage, right? So of that, where was the maximum outperformance and where was the maximum underperformance seen in terms of sectors?
So in terms of outperformance, banks were the clear winners over there. Significant improvement, and there are upgrades also. Auto also is holding guard. After almost about 5 years of lower growth, now we are seeing a very strong growth, and this may continue for maybe one more year.
Hmm.
And technology, we are seeing stable movement, not much of upgrades, but having seen a major cut, now things are looking a little better over there.
Okay. And which were the top earnings upgrades for you post Q3?
So I think in case of upgrades, the major ones are Tata Motors,
Okay.
ONGC, Bajaj Auto, Dr. Reddy's, and Coal India. This is where we have seen a significant upgrade for FY24.
Okay. And downgrades?
And downgrades are there in names like Divi's Lab, where the
Hmm.
numbers were Howler, Bharti, Eicher Motors, JSW Steel, and Tata Steel. So basically, the oil and gas and metal sector, we are seeing a significant downtick. And as we see the global backdrop not looking that great, that is where we are seeing a bit of a pain.
Okay. In terms of the heavyweight companies, how did they perform in Q3 for you? You know, companies like Reliance Industries, SBI, ITC, these heavyweight companies that have had a good run on the stock markets as well in the last year as well. So earnings, are they really substantiating the kind of an move and also looking at some kind of considerable upside that one can look at?
So many of these heavyweight companies that you mentioned, Reliance, SBI, ITC, Tata Motors, Kotak,
Yeah.
HUL, Maruti, they delivered relatively better numbers. Okay,
Hmm.
so that is actually helping the overall Nifty. So majority of the Nifty growth that we are talking about, 11%, is
Yeah.
driven by these names. And we think that this may continue for another year or so, and we are looking at almost about 16 to 18% growth in the earnings for these top heavyweights.
Okay. And where exactly would you say that there is opportunity post the earnings for investors? Where should they increase or decrease the exposure now?
So, from a post earnings point of view, the sectors where we have a positive view, where one can really look to either increase the exposure, or if you are creating a new portfolio, you can have a slightly overweight position. They are technology, banks, auto. One important highlight that we should also bear in mind is that the consumption sector is where we are seeing a lot of slowdown, both in terms of the staples as well as discretionary consumption, which is a major, disappointment for the overall market. So that is where we think that one should keep a little underweight position, the consumption piece. But otherwise, we think that these three or four sectors, one should have a slightly overweight position,
Okay.
and should be good enough for next 1 or 2 years.
Okay, so let's talk some specific stocks also in terms of the sectors that you have highlighted in your report as well, which are the sector leaders that have really caught your attention post the earnings per se. You did talk about banks and autos for sure as leading the pack this time around as well. Overall speaking, for autos, the kind of issues that the sector has dealt with, do you think those sectoral issues are now slowly receding and things are looking better for the auto sector fundamentally, structurally as well, going forward from here? And if at all we were to talk about some names apart from Tata Motors, which are the other names that we would be really talking about here?
So when it comes to creating the portfolio or the ideas where we have a positive outlook, specific names we could talk about are, TCS, ITC,
Yeah.
Bharti, Axis Bank, Sun Pharma, Titan, ONGC, Mahindra Mahindra. These are the names where we have a positive view. About
Yeah.
auto, yes, things are looking a little better in terms of chip supply situation. The domestic demand story remains by and large good for the passenger cars, not so much for two-wheelers.
Yeah.
So we think that Mahindra and Maruti both are relatively better placed.
Okay. And in terms of valuations now, post the earnings, where do you get more confidence in terms of the valuations currently? We've seen a lot of volatile move the previous year and the starting 1.5 months of this year as well. And looking at the earnings promised right here, where do you see valuation comfort?
So valuation comfort is in two or three pockets. One is that the banking and the financial services, there is a lot of valuation comfort because you're seeing growth also, helping that. And the mid cap and the small cap stocks have actually underperformed, particularly the small cap stocks. So wherever you see the stocks getting beaten down and where the earnings are relatively better, that is where one should really focus upon. So just to give you a few names, we like Poonawalla FinCorp, we like Lemon Tree Hotels, we like APL Apollo Tubes. So these are the mid cap and the small cap companies where the
Okay.
numbers have been good and the stocks also have by and large corrected. So which should definitely be an opportunity for investors.
Okay. And in terms of the guidance going forward as well, any particular companies that came into your notice, in terms of the management commentary on the positive outlook going forward from here, from this entire mid and small cap basket also, if you can name a few?
So we had a good commentary from names like Ultratech, Lemon Tree, Indian Hotels, also Axis Bank. Last 2 quarters they've been surprising on the overall return on assets and overall earnings picture. So that is where we should definitely be focusing on. And ITC has been a big surprise, both from a budget perspective and the cigarette volumes growth and other businesses contributing so well. And ITC is relatively cheaper, though it has not really fallen. But when you compare it with the staples, it's far more cheaper. So that is one stock that we've been liking.
Okay, understood that. Now, since you talked about banks, I wanted to understand from you. We've seen the kind of leadership that the banks have displayed even in the stock market performance of late after a long time of underperformance that we saw during the COVID era. But now, beyond that, which segment of the banking and financial space will really be taking the lead post the earnings? Also, if you've got some kind of highlights there, should one really stick with the private banks, or the PSU banks still have an upside after this kind of a move, the surprising substantial move that we've seen on the upside after a decade, almost the kind of move that we've seen there? Or the non-lending space also looks interesting. How would you really advise investors to approach this space now?
So clearly, this is the one sector where you will see decent amount of growth, and large part of the growth that will happen next 1 or 2 years will be contributed by banking. So it
Okay.
makes sense to have an overweight position. And as far as PSU versus private banks are concerned, I think from a 2 year perspective, I would say that private banks are relatively better placed.
Okay.
PSUs, because of the fact that another maybe 2 or 3 quarters, you will continue to see improvement in the operating metrics and the return on assets, etc. So you might have some more room on the way up, but they are not necessarily 2 or 3 year kind of a great story. So within PSU, SBI, BOB, Can Bank are the preferred picks, and
Okay.
in private banks, Axis Bank. Definitely. And apart from that, one can also look at ICICI Bank. These are the two names where we would really go with.
Okay, what about the oil and gas and the chemical space, fertilizer space, these kind of, or agro space? How have you analyzed these particular sectors post the earnings?
So oil and gas has been a major drag, and you also had some issues in terms of the government trying to impose the windfall tax, etc. So there is a de-rating which has happened. But within that, we do like ONGC. It's a great, proxy to the crude oil price plus dividend yield. So definitely ONGC is something that we would be okay with having a small exposure.
Mm-hmm.
And as far as chemical space is concerned, I think there are a lot of moving parts. China is opening up, and there's a slowdown in US and European Union. Also, things are not very clear.
Yeah.
So we want to be a little more specific there, and we would definitely go with very few companies. So Clean Science is one company that delivered
Okay.
relatively better numbers. We'll go with
Okay.
that.
Okay. And what about the new age technology companies? Have you covered that at all? Is that under your coverage?
No, we do not cover any of
Okay.
the new age fintech or platform companies like Paytm, Zomato, or Nykaa, etc. We think that they
Mm-hmm.
are trading bets. So when there is a some sort of a correction, typically at some point they give you a 10-15% kind of an uptick. So I think one should just take a step by step short term view on that, and not take a 2 or 3 year kind of
Okay. Okay. The one sector that we haven't touched upon really is the pharma space. I mean, like, of course, this sector had their own sweet spot during COVID-19 pandemic. But beyond that, we haven't seen any, performance really when you talk about the stock market performance. But earnings per se, how did you analyze? Are there still some issues that largely may disappoint the investors who are holding on to the pharma names?
So a lot of moving parts there. The generic pricing in US is not that great. Some companies are grappling with the US FDA related issues. Also, domestic side, some companies are not showing as much growth as they should have been. So we would be very specific there. I think Sun Pharma is something that we have a very high conviction on. The rest of the companies, by and large, the upside is not there, or there are challenges, and we would be more comfortable with the healthcare space. So Apollo Hospital
Okay.
is something that we would go with rather than having too many pharma companies in the portfolio.
Okay, understood. So, just in the end, any dark horses that you spotted after the earnings that came in as a huge surprise, and something that was absolutely, disappointing as well, and that you would want to just throw out of your portfolio at this point in time?
So positive surprises were there in APL, Apollo Tubes, Poonawalla FinCorp, Lemon Tree Hotel. These are the
Yeah,
names where the numbers were much better than market expectations. And in terms of the companies that did not deliver, there are many companies where the performance was not good. We touched upon this entire oil and gas and
sure.
healthcare. So pharma is something where still the comfort is not that good, because you keep getting negative news flow, and
Yes.
one is not very sure how things are going to pan out. So I want to be little underweight when it comes to pharma and also the oil and gas space.
All right, understood that. Well, thank you so much, Mr. Jani, for being with us and sharing all these wonderful insights from your report also, and helping our viewers really navigate through how to really approach these different sectors post the earnings, and how to approach their investments right there. Many thanks. Always a pleasure having you with us on Business Today TV, and we'll continue to discuss more about markets going forward as well. Quickly, let's look at how the markets are trading at this point in time. Now 117 points down for the Sensex. So it's drifting lower, 60,884, 17,900 breached on the downside now for the Nifty as well. It's down by 52 odd points. So 0.3% lower for the Nifty at this current point. Will the markets drift even further lower as we approach the closing and the second half of training session as well? We'll keep an eye out on that. But overall earnings per se, you've got to understand from Hemang Jani as to how do you really see the way earnings have panned out, because markets really do give a lot of importance to earnings and fundamentals as well, and which are the sectors that have emerged as the top performers and the underperformers, and therefore you can now gauge your own approach to investments in these particular sectors, and certain of the names that he also pointed out as their own preferences post the earnings too. With that, we wrap up this edition, but do stay tuned on to Business Today TV to catch all the updates from the world of business and stock markets. Many thanks for tuning in for now.
How would you think that the government can help, the central government can help with respect to building sports infra in the cities?
We are